You've been telling yourself you'll start investing for months, maybe years. You've saved the money. You know it should be working for you by now. But every time you try to figure out where to put it, the same thing happens. Too many options, too many opinions, too many people who sound smart but say the opposite of each other. So you do nothing. And every month you do nothing. The gap between where you are and where you could be gets quietly wider. Here's the truth. The people who actually know how to invest don't always understand more than you. They don't necessarily follow the markets more closely. They don't always have better information. What they have is something most financial advice completely ignores. Not a better strategy, not more discipline, a different psychological relationship with risk, patience, and their own emotions. And by the end of this video, you'll have it too. A 2023 study published in the Journal of Behavioral Finance found that investors who scored in the top 20% on financial literacy tests performed only marginally better than those in the bottom 20%. The gap between knowing what to do and actually doing it is where most investors lose everything. The first pattern, they started with $50 on purpose. Most people think they need thousands of dollars to start investing. So they wait. They save up. They tell themselves they'll start when the number feels big enough to matter. People who actually know how to invest did the opposite. They started with an amount so small it felt almost pointless. $50? $100? An amount that wouldn't hurt if it disappeared completely. This wasn't about the money. It was about building a tolerance. They needed to feel what it's like when a number moves without their permission. They needed to watch $50 become $46 and not care. Then invest $500 and watch it become $430 and feel uncomfortable, but stay. Then invest $5,000 and watch it become $4,200 and notice their hands wanting to pull it out but doing nothing. Each level trained their nervous system for the next. Think about why you haven't started yet. It's probably not the money. It's the fear of watching real money shrink. They felt that same fear. They just felt it with $50 first. Psychologists who study skill acquisition call this graduated exposure, deliberately introducing small doses of discomfort to build tolerance before the stakes get high. Therapists use it for phobias. Athletic coaches use it for pressure training. People who actually know how to invest used it on themselves without knowing the term. By the time they were investing $500 a month, the emotional landscape was already familiar. A 15% drop on $2,000 feels different when you've already survived a 15% drop on $200. The math scales. The panic doesn't, because the nervous system already adapted when the numbers were too small to matter. You're waiting until you have enough to start. They started before they were ready, and that's exactly why they were ready when it mattered. The second pattern, they built their identity around the process, not the outcome. Most investors tie their self-worth to their portfolio performance. A good month means they're smart. A bad month means they made a mistake. Every market movement becomes a personal verdict. People who actually know how to invest detach their identity from their returns entirely. They don't feel smart when the market goes up. They don't feel stupid when it goes down. Their sense of self as an investor is built on whether they followed their process, not whether the market rewarded them for it. Psychologists call this process identity versus outcome identity. Research in performance psychology shows that athletes, surgeons, and military operators who identify with their process rather than their results perform significantly better under pressure. The same principle applies to investing. When your identity is tied to outcomes, every dip threatens who you are. When your identity is tied to process, a dip is just weather. You don't control weather. You control whether you stayed the course. You can test this right now. Think about the last time the market dropped. Did you check your account more often? Did you feel the urge to move something? That urge didn't come from your strategy. It came from your identity. And the next pattern explains what happens when people let that urge win during the worst possible moment. The third pattern, they invest the most when they're the most afraid. Every financial instinct you have tells you the same thing during a market crash. Get out. Sell. Protect what's left. The headlines confirm it. The group chat confirms it. Your stomach confirms it. People who actually know how to invest have a rule that directly contradicts this instinct. When the market drops 20% or more, they buy more. Not because they feel confident, because they wrote that rule down when they felt nothing, and they follow it especially when they feel everything. This isn't bravery, it's engineering. They designed a system that forces them to act against their own fear at the exact moment their fear is loudest. The data behind this is staggering. JP Morgan studied the S&P 500 over 20 years and found something most investors never hear. The 10 best days in the market, the days with the biggest gains, almost always happened within 2 weeks of the worst days. The biggest crashes and the biggest recoveries are practically neighbors. The investors who sold during the crash weren't just avoiding pain. They were locking themselves out of the gains that followed days later. Your instinct says run when the market crashes. Their rules say run toward it. And the rules win because rules don't feel fear. The fourth pattern, they never talk about their investments. You've probably noticed that the loudest people about money are rarely the wealthiest. The coworker who won't stop talking about his crypto picks, the friend who casually drops her portfolio return at dinner, the guy on social media showing screenshots of his gains. People who actually know how to invest are almost always silent about it. Think about the last investment decision you made. Did anyone else know about it? Did their reaction change how you felt about it? This isn't modesty, it's protection. Every time you share an investment decision publicly, you invite pressure that distorts your future decisions. Tell a friend you bought a stock and suddenly selling it feels like admitting you were wrong. Post about your portfolio. And now a downturn isn't just a financial event, it's a public embarrassment. Share your strategy and suddenly you feel obligated to defend it even when the smart move is to adapt. A 2022 study in the Journal of Experimental Social Psychology found that people who publicly committed to a decision were significantly less likely to change course even when presented with clear evidence they should. Public commitment creates a psychological rigidity, and rigidity in investing is how you ride a bad position all the way to the bottom. People who actually know how to invest remove the audience entirely. Their portfolio is between them and their brokerage account. No one to impress, no one to disappoint. No one whose opinion could turn a rational decision into an emotional one. Ask yourself honestly, when was the last time a friend's opinion changed how you handled your money? That moment cost you more than you think. The fifth pattern. They defined their number before they started. Most investors operate without a clear definition of what they're investing for. The goal is vague. More. Growth. Retirement someday. Financial freedom eventually. If someone asked you right now what your number is, could you answer in under 5 seconds? Most people can't. And that's the problem. Without a specific target, a 20% drop feels like a catastrophe, and a 20% gain feels like permission to spend. People who actually know how to invest defined a specific number before they invested their first dollar. Not a fantasy number, a calculated one. How much do I need per month to live without working? How many years until I need it? What rate of return can I reasonably expect? The answers produce a target, and that target changes everything. With a defined number, a 20% market drop isn't a disaster. It's a delay of 14 months on a 20-year timeline. Without a defined number, the same drop is a psychological earthquake because you have no framework for absorbing it. You know where you're going. The market's job is just to get you there on a timeline you've already accepted might vary. Start here. This week, open a brokerage account and put in $50. Not $5,000, not $500, $50. Watch it move for 30 days. Your only job is to feel what investing actually feels like before the stakes get real. This month, write down one rule for the next crash. Something specific. When the market drops 20%, I invest an extra $200. Write it now while you feel nothing. That sentence will be worth thousands when the panic hits and everyone around you is selling. And tonight, before you close your phone, define what enough means for you. Not a retirement number, just the monthly amount where work becomes a choice instead of a requirement. Write that number down. You don't need to know how to get there yet. You just need to know where there is. The people who actually know how to invest started small, built their identity around discipline instead of returns, bought more when everyone else ran, kept their mouth shut, and defined their number before they invested their first dollar. That's not financial skill. That's psychological architecture, and is the only thing that separates the people who invest from the people who build wealth.